Welcome to the special edition segment celebrating the 10th anniversary of the Nedgroup Investments SA Equity Fund managed by Laurium Capital. Today, we have not one, not two, but three of the fund's co-portfolio managers joining us. That is Dwayne Dippenaar, Junaid Bray, and last but not least, on the line from Johannesburg, Murray Winkler, who is also one of the co-founders of Laurium Capital. Welcome, gentlemen. Thank you for your time.
Thanks, Mansoor.
Thanks.
I'm going to get straight into it. We have a lot to cover. I'm keen to get your insights. And, it's 10 years. It's been a long time, quite a successful time with the fund. We look at the fund's statistics. You have delivered alpha over that time, consistent performance. How has the fund evolved over time in terms of the investment philosophy, process, and team? Maybe Murray, as the co-founder, maybe you can kick us off.
Thanks, Mansoor. So if we just put in perspective, the firm Laurium was started 15 years ago. We started as hedge, and then we moved into the long-only space. So it was 5 years later that we actually started running the equity fund, SA Equity Fund. And I guess the team has grown quite a bit from that. So initially it was Gavin and I were running that. And the last 4 years, we moved to a multi-counselor approach with Dwayne and Junaid also running the fund. From a perspective on the philosophy, still very much fundamental bottom up with a bit of a macro overlay, very focused on financial analysis. And that remains the core over the 15 years. So there's no change on that. We refine it as we go. The team has grown, but the actual philosophy is very much the same. There are always ways to tweak and improve, and I guess over time we've seen some improvements on that, definitely some improvements. But yeah, very much the same process and philosophy. Yeah.
So maybe I can add there. The philosophy. I've been with Laurium just over 8 years, and the philosophy has been the same throughout that process, as Murray said. Bottom-up fundamental with the macro overlay. There's a lot of that hedge fund DNA where Murray and Gavin came from in there. So we take advantage of our opportunities in the market, and the process has been very similar. But that's where improvement has been done over time. As more people have joined the team and the team's got bigger, that process has got more and more robust. Yeah. And so there's been improvement. But the philosophy, the core philosophy has stayed the same for 15 years, and we truly believe that's what helped generate the good returns and the alpha over the time period for the fund.
So very much an iteration over time, improving
on the process side of things. But the philosophy, the core bedstone, the philosophy hasn't changed at all.
And everybody joining the team has also bought into the philosophy, so that doesn't change. We all buy into the same philosophy, bottom up, fundamental, valuation based. That's what we do.
Yeah. And you found it sort of easy, bringing on new team members into the team, that integration that you speak of. It's sort of, it's what you look for in team members, I suppose.
Exactly.
Well, it's essential when somebody joins the team that they firstly believe in that philosophy and it resonates with them. And obviously through the interview process, they have to fit in with our culture and philosophy as well. And so we've had fantastic additions to the team over time. The Tantalum team has also joined, and their philosophy was, lockstep in with ours. So that was a great addition to the team. And I think the team has really gone from strength to strength over the last period.
Speaking of the team, Murray, as you mentioned, a team of now 4 multi-council portfolio managers. How do you collaborate and communicate with each other as portfolio managers and with the broader investment team?
So I guess some of us are based in Johannesburg, some in Cape Town. We've had a semigration at a big rate down to Cape Town. The office there is now 20 people, but we have a morning meeting, 8 o'clock every morning. There's a meeting, so we're all engaged in that. What's discussions, company results, any topical issues. Then we have interactions. On Friday, we have a full-on sort of research meeting that Junaid, as the head of the research, chairs that. So we interact there. And our offices are all open plan. So there's a lot of interaction that takes place. And we have asset allocation meetings as well, which is once a quarter, formalized ones, but sort of 5 of us sit on that. And it's being open plan, lots of discussions, and it's really quite easy to make changes and get different stocks into the portfolio or out.
But maybe the thing to add is, while we've said the team has grown, it's still, the team is small enough that we can interact with each other on a daily basis all the time kind of thing. So any stock move we can take advantage of. we're always talking to each other, always looking at each other's portfolios, comparing ideas. And then obviously all four of us would examine the overall portfolio to make sure we're getting the best result for clients at the end of the day. So there's constant interaction. So there are formal occasions, as Murray said, the 8 a.m. meeting every morning, looking at what's happened overnight and the previous day. But then right through the day, we'll always be interacting with each other. Yeah.
But that constant interaction, I think, it is one of our edges, that the teams, it's a very closely knit team. Whether you based remotely, we have a wall where we just, we can speak to each other at any point in time. And then obviously the team based together, there's lots of daily interaction. And as Dwayne says, I mean, we're agile. We can make decisions quite quickly and implement them.
That's that constant flow of information. It's quite important.
Correct.
Yeah.
So very little bureaucracy, So that while the team has grown, it's still quite a dynamic team, and we think we can move very quickly.
Excellent. I want to get into the meat now, sort of your experiences in managing the fund. So what are some of the lessons or insights that you've learned from managing the fund and working together over that time?
So I think one of the things, if we're always questioning ourselves when we get something wrong. Why did we get it wrong? What is the lesson we can learn from that in order not to make a similar mistake again? Yeah. And I think, a value trap is often something that always looks interesting because the valuation's cheap, and it often involves a turnaround story, which is often difficult to execute. So I think over time our aversion, and we have made mistakes. I mean, clearly, you're never going to get everything right. Our aversion to value traps is something that stands out for me as a big lesson over my career, and especially managing the fund.
I would agree with Junaid. So the value trap, when a stock looks very cheap, I mean, that could be a great opportunity, but often it's in a lower quality company, and we have been caught by one or two of those over time. So I think we've stood back and said, at the end of the day, you'd probably earn the higher quality spectrum of companies kind of thing, and you're probably willing to pay slightly more for it. That being said, there still are great opportunities in companies that are lowly valued. We'd probably just be more skeptical around investing in many of those over time.
Murray, from your side?
High level to say, I guess it applies from being in markets a long time, but we have a ranking tables, analysts and PMs cover stocks. And then we have a ranking, literally expected or fair value for all stocks, let's say 130 stocks, top to bottom. And I think the one thing is, and we have a rigorous process to get there, but I think it's the one thing that one always learns is, and analysts can be detailed, this is my fair value through the cycle, fair value. But the old adage, which comes back to, I think, which Warren Buffett probably sums up markets over time, is that in the short term, the market is the voting machine. So sentiment sends it 20, 30, 40% away from fair value. So it's understanding that flows. If there's money going out of SA, changes in regs, your valuations can get way away from true value. And that's a short-term thing. But the long term, it's really about trying to get he always said earnings, but it's actually cash. The market will weigh the cash over time. So just an adage to that. And so over time, it's getting the cash flows, the net cash flows of a business right. But I think it's often one can get caught thinking, oh, this is my fair value. Jeez, but the market takes a very different view. And then it's understanding flows, who's doing what's the thinking overall. So I think those are nuances that as you're around a long time, you learn. And we've been on the receiving, listen, as Junaid says, if we get 60% of what we do right over time, maybe 55 to 60, we're doing pretty well. It's a tough industry. And yeah, a few of the stocks, when markets can turn against you quite a bit, and analysts can have a very clear view on value, but market has a very different view. So I think it's understanding those dynamics as well.
Indeed, I think the market can be the biggest humbler at times. On that, and you mentioned, some of the mistakes that inevitably will crop up in the life of a portfolio manager. What are some of the biggest challenges or mistakes that you've encountered in your careers?
So I think often when a mistake happens, I think that one of the biggest challenges with that is you often see the share price fall a lot. So you liked an idea, and maybe it was, and now it's 30, 40% cheaper. So what is critical to at that point is to reassess, has the investment thesis changed on this company? And then, you know, it's always a tough decision to crystallize that loss and actually sell and walk away. But you do a lot of work to get to that point, you know, when that point does arrive. And it's often challenging because, and there are often different views on the team. So it's, you know, bringing all that together. And as a portfolio manager, making that decision is not often easy, but it needs to be made.
Indeed.
I mean, look, we can name a lot of stocks that we've got right.
Yeah.
Luckily, over time, we've got more, I mean, wrong. Luckily, over time, we can name more that we've got right. I mean, lessons I've learned is, you know, you need to be very skeptical around what management say often. So we engage with management teams often and stuff, and they can have quite rosy outlooks on their businesses. Obviously, you'd want them to be positive in the business. So be very skeptical around that. And then obviously, if you get any feeling that management is not honest or ethical, that's a big red flag, and things like that. That's where you really need to make a call pretty quickly and generally avoid stocks like that. Yeah.
Murray, perhaps on your side?
Yeah, I mean, I think as Dwayne says, I mean, fortunately over time, I mean, I guess if you look at the gross alpha over 10 years, it's just over 2% per annum. Gross alpha, we'd hope to have been a bit better. Net sort of just above 70 bips. So it depends which class you're in. But whereas we hear a lot of people saying passive is good, and it's a way to go. But I still do believe that if you look in the SA market, the opportunities, the skill set, it's not as efficient a market as, say, the US. And so we have managed to get net alpha for 10 years over time. And the hit rates, if you measure on a 1 year rolling of 3 and 5, sits, I think Junaid will probably remember the numbers better, sort of close to 65 to 60%, 80%.
80%.
Sounds high, but not, yeah. But it's pretty high on that. So it's been good. We always strive to try and be nice to do better. Some of our other funds have had much better alpha over time. But yeah, I think in the equity space, we're pleased, but we can always do better.
Yeah, and indeed, I think, you know, being an SA-only sort of fund, you know, not having the sort of luxury of having a global universe to pick from, that's sort of an added challenge. So despite that, you know, I think you guys have done really well. And we know the challenge is coming of managing an SA-only portfolio. Conversely, you know, also, I suppose it feels good to us get those calls right. So what has been your best investment calls? Dwayne?
So we've done very nicely out of NASPA's process. So we've also, you know, besides the core investment thesis around 10% and the discount, we've also traded between the two lines as the discount is flexed between NASPA's process, and we've traded around the corporate actions, the unbundling of process, etc. So we've done nicely out of that. Another stock that's done well for us over the last 5 years is MTN, and I truly believe that's because of the cross-pollination between the South African team and the African team. And the African team, you know, we got guys traveling into Africa all the time, and they've got strong views on what they think will happen in the local economies, Nigeria, Kenya, Egypt, that affects the telcos. Nigeria being a big one for MTN, and their view on currencies there has definitely helped our call and our ability to trade around that. So those are some of the stocks that have done nicely for us.
Just to add to what Dwayne's saying, I think, you know, sticking to your process, when we analyze that alpha has been generated over time, if we use the stock example of MTN, it's not only, there have been times when we've owned a lot of MTN, and there have been times when we've owned zero. So it's sticking to your philosophy and your process. So when we've got a fair value and we see the stock is very undervalued, we'd obviously be adding a lot to it. And there were times when we felt it was overvalued and we actually sold down to zero. So when we're looking at how much alpha we've made over time, it's a combination of owning it and not owning it through that period. And then I think some other examples were, you know, some of the banks, and then Mediclinic as well. I think, you know, we bought quite a lot when it was completely out of favor post-COVID. Hospitals were empty. And obviously with a fixed cost base and utilization low, profits were low. We felt that was going to be temporary, and, you know, profits would recover eventually. And Mediclinic particularly had run their business quite well with diversification. Switzerland, you know, the UAE and South Africa. And then, you know, at that point we bought in very undervalued. We got the offer from Remgro, and we made a lot of money for the clients out of that position. Yeah.
Well done. Murray?
Yeah, I think the one that really did stand out was that Mediclinic at $60. I think we bought and no one wanted, or below, between 55 and 60. And the next thing we got an offer sort of close to 100 for it, which was quite exciting, sort of 6-9 months later. But yeah, I think that we've traded around quite a bit, probably more so in the early days, a bit more trading. And I think that on the ones where we got wrong, I mean, in recent times, I guess last year we had a tough year last year, and I think that was on resource side. We weren't quick enough to cut on the platinums in particular. We are seeing a bit of a resurgence in the last 2 or 3 weeks with commodities and that. And the other one was Sasol, which was really that we trimmed a bit of it, but we've had a decent amount. And there's been massive selling, just even though the fundamentally looks so cheap, just money flowing out of SA, people choosing Chevron or BP, etc. So a lot of the big global houses getting out of it. And I think that's a flow dynamic that we underestimated just how low it can go. We think it's totally overreacted on valuations now, but we actually have seen it up sort of in the last 3-4 days, even 10% plus. But we're on the wrong side of that. So I tend to remember the ones we get wrong.
But I suppose those are the ones that you learn from the most.
You learn, yeah, absolutely, yeah.
Dwayne, you touched on something now, the Africa team that you have, and I think that is also one of the edges that you have at Laurium Capital. Not a lot of managers tend to look into Africa, as an investment destination. They find maybe it's too risky. Maybe just talk to us a bit about that Africa team and that expertise that you have.
Sure. So look, the African team's been within Laurium for a long time. We started investing in Africa multiple years ago. I mean, there are other managers that have African teams, but I think one of the big differences is because our investment team is still reasonably, quite small, the African team sits with us. They're in our morning meeting, we're debating the stocks together. So there is a lot of cross-pollination, which for the stocks I cover, I've found has been really positive and created great insights. And I think most of us, if you look across all the analysts and the PMs, have covered both South Africa and Africa over time. So we've rotated through covering Africa, and I think that's also given us the ability to sort of understand African markets, understand the different stocks in there, the different stock markets and the currencies and the macro environment, which has helped a lot.
So yeah, I think on Dwayne's point, our team's integrated. So the analysts who cover banks, our local analysts will cover banks in Africa, similarly with telcos, and because they've got divisions in those countries, it just gives us a better understanding. And we've also added global to that now. So our analysts, our same team covers global stocks also. And that, I think, that's given us a better understanding of some of the non-resource rand edges, the global stocks listed in South Africa. So the likes of Richemont, British American Tobacco, Bidcorp, where because we've got a better angle on, what are the global trends and what are the valuations from a global perspective. I think it has given us better insights into some of the trends on the local market.
Matt, perhaps was it,
yeah. I think to add really on the Africa side in particular, because globals, we've always done global stocks. If we go back, I can go back 20 years ago. Rob, myself and Gavin in the late 90s doing Richemont, luxury conferences offshore, seeing you'd have the luxury 2 days in offshore, then you go to the consumer conference. So we've always looked relative valuations. A bit more focused now, I think, as Junaid says, of Rob, and we've got another person sitting in London as well, Ross helping him. And the analysts a little bit more focused there. But Africa really is where I think, because SA is so interlinked. If you look at Standard Bank's results that have just come out now, they shot the lights out in Africa. Almost close to 50% of its earnings came from Africa. Now, when you meet Matt's our banks analyst, meeting with the management teams here, which we all do, then you go and meet with the teams in Nigeria and Kenya, meet with the CEO, CFO. You get some quite interesting dynamics there on that, and you can cross-check on that. So I think that's definitely having the same analysts covering things. And then also PMs. Gavin still is a PM on Africa as well. I used to be a PM on Africa up until 5 years ago. For 10 years, we were PMs on that. So I think, and the teams now we're running bonds, the bond there with Mel and Paul, bond fund and then the equity fund. So we do get some pretty interesting and know the markets quite well. And there've been some big moves that are happening, dynamics, currencies, getting money out. So I think there's definitely an edge in our team and what we do by being quite big in Africa. We're running, I don't know how much now, we must have almost $300 million in Africa, directly into Africa. So there's a lot of interaction that happens there, and it does give you a bit of an edge at times. We're quite surprised some of the brokers come out with comments about money's coming out of Nigeria, it's coming out at 12. Then we know it's not coming out at 12, but they're picking it up, or it's totally wrong. Because we know the companies that are not getting money out and who is getting money out. So I think there's a bit of an edge, which is quite nice, that integration.
Thanks, Murray. I want to bring it now to the present. What are some of the key themes or trends that you're following or investing in currently, when you look at the SA market?
I mean, it's a SA equity fund, so obviously one of the big drivers would be the local macro climate. And let's be honest, it's been very tough in South Africa the last while. We went through the Zuma years, and there's a routing of a lot of SOEs, a lot of corruption, underinvestment in SOEs like Transnet and Eskom. So I mean, it's been a very tough market, and we've seen very little beta in the South African segment of the market. But we believe now, if you look at what's happening, we're seeing real structural change. And I've discussed it with you before. We've seen the government deregulating sectors, so it's deregulating the energy sector, deregulating the logistics sector, and we believe that'll help fix the electricity problem in South Africa, the logistics problem in South Africa, and that can really drive GDP growth going forward. And if you overlay the very low valuations in the South African market at the moment, we think they're fantastic opportunities. And then on top of that, people are very worried about the election. We think you'll have a decent outcome, even if ANC drops below the all-important 50% mark. They'll have a coalition partner like the DA or IFP, and pretty low risk that it's a coalition with the EFF, which would be the downside scenario. And we think that, there's been a wholesale sort of sale of our market by foreign investors, and a lot of them, we think, now that they're seeing the structural change, they see the very cheap valuations, and if we get a good outcome from the election, we think there could be a lot of them coming back into our market, and that could obviously drive the market as well. So that would be one of the big themes that we think could drive the market, along with interest rates rolling over in the second half of the year.
Yeah, I would say that, generally we don't invest on themes per se, and given the the structure of the South African market, there aren't that many themes that you can really invest in directly. But as Dwayne says, look, we being bottom-up fundamental investors, we mostly link it to valuation, and where we're seeing that valuation, as Dwayne says, is the South African market is very undervalued, both on an absolute level relative to its history and relative to emerging market, and especially relative to developed market peers. And we, as Dwayne pointed out, I think there's a lot of structural changes that are taking place that we think will be very positive for the next 3, 5, and 10 years, as we see these changes coming through. And it should help, to drive possibly a re-rating in our market, especially of these low levels. When you get many stocks are trading now at 6 PEs. What used to be 7 to 10 PE stocks are trading now at 5, 6. So when you get a re-rating on from that low level, just 1 or 2 turns gives you fantastic returns. Yeah.
Matt, anything like to add to that?
Yeah, look, I think running an SF fund has been pretty tough. I mean, if we talk the last 10 years, your growth's probably been 1% per year. So you haven't had the tailwinds you did have in the initial 10, 15 years from democracy. So that's been quite tough. We do have the dual listeds, but a lot of our dual listeds and stocks are linked to, it's EM, it's China. So if you look at the Naspers, very much in China's been a big issue. Richemont, which has been quite volatile, but it's done pretty well, also linked a bit into China. ABN Bev is emerging markets. So EM has done so badly, and that's the overriding factor, is how does EM do to how we are looked at. And then we obviously have our own problems on top of that as well, which has been quite an issue. So I think, as Dwayne and Junaid are saying, the valuations have got to pretty extreme levels. Bond yields is a big factor in our market. I mean, we've got our 10 years at close to 12%. So 7 real is based on current spot inflation. It's implying, if you look long run, it's implying inflation is going to be 7.5% or so the next 10 years, over 7%. Now, it might be, but I think that what could happen and we hope it happens, theme-wise. I think at some stage the US will drop rates. We're still talking about 3% down this year. Is consensus, or two? It's actually, I think, 70 bips, and then for the rest of the year is consensus. And if that happens and the dollar starts to weaken, EM should do quite well, which is good for us. Plus, we get through the elections, and it goes okay. Coalition or something, that depends what happens, a lot of different outcomes, but probably close to 40%, low 40s, maybe ANC, some sort of coalition. You could have foreigners returning. I mean, as one of the brokers was saying, they probably of their books used to be one of the bigger guys, 60% of the trade used to be foreigners. Now they sit at about 10%. If that swings, if EM gets a bid, elections go okay, rates drop, commodities could do, because they're already doing quite well in a strong dollars environment, and SA could do quite well. So we could have, I don't know what the probability is. It's not, I mean, it's one of the scenarios, and maybe it's a 50% chance. Over 6 to 12 months, you could have a really big re-rating happen. So 12 to 18 months. So hopefully that's what happens. Some good news. As Dwayne said, there are structural reforms taking place. They're going slower than you'd like to see them, but at the margin, it does make a bit of a change. So yeah, I think an SA fund could actually do quite well the next 18 months, whereas it's been doing very poorly relative to the global, particularly the US, for the last 5 years.
Thanks, Matty. I think I want to bring it also now sort of closer to the fund as well. What are your expectations or outlook for the fund? And you've touched on sort of the SA market in general. But as we look forward, just given the positioning of the fund, some of the stocks you hold, maybe some of your insights there.
So I think we touched on some of the positive drivers that we're seeing, and valuations at the moment. I mean, we're seeing them exceptionally attractive. The likes of some of the banks we've been adding to, some of the retailers. And then I think some of the due listeds here also looking quite attractive. We still held on to our platinum position. It didn't work out for us last year, but we are seeing sort of early signs of a bit of a recovery there. I think those are some of the key positions in the fund.
Well, besides the structural change in South Africa, which you can debate, how long does it take, how much does it drive, and the pickup there and the low valuations, a big driver, as Murray mentioned, would be China. And if we look at the Chinese market, firstly, a stock like Tencent, we think the valuation looks very attractive. So that could be a big driver. And on top of it, while the property sector there, we don't think recovers anytime soon, it does seem to be the rate of deceleration sort of slowing. And there is a lot of stimulus going into the manufacturing sector, etc., which we think will support the economy going forward. And that's a big driver for EM and the South African market from a commodities perspective, luxury perspective, and I suppose process. So we think, those two combined could really generate very decent returns for our investors going forward.
Matty, perhaps the last 2 cents from your side.
Yeah, I think if we look at the portfolio, we've probably got more Sasol than other people, which I think that one could get surprised in the next 6 to 12 months. Oil where it is, revisions coming through quite strongly, and the diversified miners as well, where we have, the way copper's behaving, which we got quite a lot of Anglo American and Glencore, which they've been starting to move quite nicely. So we've got decent positioning there, and the banks is another area. While I think that they're very under-owned by foreigners at the moment and over-owned locally, I think if you get through the election and it's okay, and bond rates come down, that's an area that you could see, while loan growth is quite slow, you could see a decent re-rating, and they're sitting on anywhere between, I suppose 8-9% divi yields, with growing at mid to high single-digit earnings growth. So those areas look very good and could re-rate quite a bit.
Thanks, Matty. There's a question which I didn't ask earlier, and I'm going to sneak it in now. And it brings us back to sort of people, because it's always, fund management is always about people, the people managing the assets. 4 portfolio managers, portfolio managers on one fund. How often do you agree and disagree? You can feel free to.
So I think we mostly agree. I think, because we at the starting point, again, we all buy into the same philosophy and the same process. So when we look at our portfolios, I'd say 90% of that portfolio, 85 to 90% is the same. There might be a position a few positions we differ on in terms of either size, and there might be an exception where there might be one or two positions that Dwayne would have in his fund that I wouldn't have in my fund. But the end result is that the client gets exposure to that. If Dwayne believes he's got conviction in an idea, or if I believe, we'll put that into the portfolio, and you get that. And often as those debates go on, we often convince each other, and you'll see, we'll get more of that into the client portfolio over time, and that's the aim.
Yeah, so the whole point of the multi-counselor process is not for the portfolio managers to try and outcompete each other, but rather to drive the best ideas into the portfolio if you've got conviction in size to get the best result for the client. And while our portfolios are, let's call it 95% the same, make no mistake, there's extremely robust debate on a daily basis. So I'd say we disagree and agree on a daily basis around many things, but we'll sit around a table and have very robust debate until we come to a result that we all have conviction in, and hopefully get that high conviction position into the portfolio.
Mari, to close off.
Yeah, I think what it does do is there will be times when one's uncertain, not quite clear, and then one of the multi-counsel portfolio managers says, "Okay, I'm going to start buying." Let's say it's first trade, starts buying first trade. And the others are decided, maybe, and then that forces the others to think a bit and say, well, actually, maybe, yeah. So sometimes it's a catalyst for action as well. I mean, there are. I mean, again, I don't know the exact number. It's probably close to 90%, because Dwayne mentioned the number he mentioned in Junaid. Probably 90% overlap in all the portfolios. So there will be one or two that are not quite convinced. And someone might have it in, but generally it works quite well, and that's why I think the portfolios, the multi-counsel portfolios, do overlap quite a lot because of the process we go through.
Gentlemen, we'll leave it there for now. We certainly look forward to the next 10 years of strong performance, but for now, thank you and goodbye.